Okay, so another type of spread that's important when it comes to market structure. Market structure is all about uh, um, it's all about the value proposition for commodities. So we talked about the gold silver ratio. That's kind of an inter-commodity spread. What we're going to talk about now is another part of market structure, which is a processing spread. And a processing spread is simply when you take one commodity and you make other commodities out of that commodity. So the best example of that is something called the crack spread. The crack spread is the economics of taking a barrel of crude oil and turning it into oil products like gasoline, heating oil, jet fuel, diesel fuel, gasohol, naphtha. There are many, many different ones. But the most liquid ones that trade are gasoline and heating oil. Crude oil trades on the New York Mercantile Exchange, and so do gasoline as a separate commodity trades on the New York Mercantile Exchange. So does heating oil as a separate commodity trades on the New York Mercantile Exchange. So let's remember that most consumers like you and me, we don't buy raw crude oil to power our cars or heat our homes or need for energy. We buy oil products. We go to the pump. We fill up our cars with gas. We fill up our oil tanks so that we can warm our homes in the winter. So again, most consumers don't buy raw crude, they buy oil products. Gasoline and heating oil are the exchange traded oil products. They are liquid markets. Crack spreads are processing spreads. They represent the economics of refining raw crude oil into oil products. And in many ways, crack spreads are very indicative of demand because the oil products don't necessarily move in lockstep with the price of crude oil. So that they're a real-time indicator of demand for the actual products that people like you and I buy. Very interesting also, when it comes to the oil market, we have many different sectors. If you trade equities, we have exploration and drilling. We have oil services, which provide all the things for the platforms and the drill rigs and all kinds of things like that. Then we have refining, which takes crude oil and turns it into gasoline. Funny enough, crack spreads are basically a real-time indicator of refinery profitability, because what do refiners like Valero or Marathon or Chevron do? They buy raw crude oil, they put it into their cracking systems, their refining systems, and they get out oil products, which they sell. So their profit margin is basically the width of the crack spread. Very interesting for those who trade equities. So when the oil price is going down, it doesn't necessarily mean that refining stocks are doing poorly. Actually, if the oil price is going down faster than product prices are going down, actually the refiners could be doing better in a bear market for oil. And we've seen that recently. We've seen, the big oil companies really get trounced lately in a bear market for crude, but we've seen refining profits stay up, and the shares like Marathon, MPC, and shares like Valero are close to all-time highs. So again, crack spreads are a real-time indicator of refinery profitability. And the crack spread levels tend to influence nominal oil prices. So that's a very important point there, because that's where the demand shows up. So let's go to the next slide, which is a slide of the NYMEX crude oil weekly prices. And as you could see, starting, basically June 2014, oil fell off a cliff. I mean, it fell from over $107 a barrel in June 2014 to $42.03 in March 2015. Very big move in a 9-month period. Then it turned around and rallied all the way up to almost $63 a barrel in May. And then it fell again, and today we're close to those $42 lows. We're trading right now, as I look at my screen, at $42.30 a barrel. So very volatile. Crude fell on increasing global production and weak demand across the globe. But the big oil produced in the United States, the shale oil, contributed to the fact that oil prices went down. OPEC didn't cut their production, so the price fell. The price of Crude oil, the raw crude oil, fell. As crude fell in January, many market analysts were calling for much lower prices, prices below $40, some below $30. I even heard one guy on CNBC talk about crude oil going to $10 and going the way of whale oil. But that didn't happen then. Why? Because those of us who watch crack spreads saw a bottom starting in January, which eventually translated to almost a 50% rally in crude that commenced in March 2015. So let's go to the next slide, which is a slide of the NYMEX RBOB gasoline crack weekly chart. And what is this? This is basically the refining margin for crude oil, and it is measured in dollars per barrel. So if we look at this, first of all, let's talk a little bit about gasoline demand. Gasoline demand is seasonal. It tends to make lows in late fall, and it rebounds into winter as refineries prepare for driving season. So declining oil prices in early 2015 pressured the gasoline crack spreads all the way down to $6.74 per barrel lows in mid-January. And mid-January is a seasonally weak time for gasoline. Keep that in mind, because driving season our cars much more in the summer than we do in the winter, particularly if you live in the East Coast, where we have days where we can't even get in our cars because of the ice and the snow and so on and so forth. But we saw something very interesting happen in January when crude was continuing to make lows. All of a sudden, gasoline crack spreads rallied aggressively, and they went from $6.74 per barrel on the continuous contract in January, mid-January. In 6 weeks, they went to $33.75 per barrel by the end of February. That is an increase of 400% in 6 weeks during the off season. Very interesting. And the crude oil rally commenced 3 weeks later, based in part from what the gasoline crack spread was telling us about crude oil demand. Today, crude oil's moved lower. Gasoline demand, based on its relative level to crude oil, remains at normal levels. It's not a bearish indicator. As I look at my screen today, as we're doing this presentation, right now crude oil is trading at $43.22 a barrel, but that gasoline crack spread in December is trading at over $30 a barrel. So that is telling us something important about demand here. Even though people are calling for $30, much lower crude oil here, the gasoline crack spread is telling us, hey, not so fast. So let's look at another chart, and that is the NYMEX weekly heating oil crack spread. Very interesting as well. Like gasoline cracks, heating oil cracks moved to lows of $19.50 per barrel in January. Now we have to remember, seasonal demand in January is strong for heating oil because it's cold. It's the middle of winter. So we moved to lows of $19.50. One other thing about heating oil is heating oil has a very similar properties and characteristics to diesel fuel. So the seasonality is not as evident in the heating oil market as it is in the gasoline market. Anyway, so we moved to lows in January of $19.50 per barrel in concert with crude, even though this is a seasonally strong period for heating oil. So we went low during a seasonally strong period. Like gasoline cracks, heating oil cracks then moved up aggressively from $19.50 in January. They shot up all the way to $33.35, which was an increase of 71% by the end of February, which, even though we're in the middle of winter and it's a seasonally strong period for heating oil, you have to remember that, there's a lag period of time. We start making gasoline, in the late winter, early spring. We start making heating oil in the late summer, early fall to prepare for demand, and then we store it. So it was kind of odd to see that heating oil crack spread just explode to $33.35, an increase of 71% by the end of February. Heating oil cracks validated the move in gasoline, and that translated to a bottom line or a bottom for crude oil in mid-March 2015. Today, heating oil cracks in the middle of summer, in the middle of August as we tape, are trading at $23.21 per barrel, which is strong for this time of year. In 2014, those cracks were at lows of around $16.50 per barrel. So $23 plus is a stronger level than last year, which indicates to us, even though oil is making lows now, there is some demand for this oil product, and these are not bearish indicators at the moment. Let's go to the next slide here. And let's just kind of sum all this up, because it's really important that we understand that the nominal price for a commodity that we see, and that's all commodities, folks, the nominal price is only a small part of the true value. The nominal commodity prices are only a small part of the value proposition for any commodity. Understanding true value helps in making better assumptions on the future direction of price. We saw that in terms of the silver-gold ratio, in terms of how it reverts to the mean. So we saw it in terms of the crack spreads, the processing spreads, in terms of how they signaled a bottom for crude oil. And these, whether it's processing spreads or the ratio spread, the substitution spread between gold and silver, understanding value, true value, helps us make better assumptions on the future direction of price. And these are all part of market structure. That the substitution spreads, the processing spreads, make up, and other aspects, which we'll cover in future presentations, are part of market structure. And market structure gives the most important clues in terms of real value for commodity prices. The gold-silver ratio is established whether each metal is historically cheap or expensive, regardless of the current nominal price. It tells us whether they're cheap and expensive relative to the price of the other. And crack spreads in oil establish demand for energy, and they can portend future price path of the raw crude. Again, we don't, as consumers, buy raw crude oil. We buy the products. So if we're going to drive a lot more because gasoline is cheap this year, it's going to show up in gasoline prices, but eventually it's going to translate because the refineries are going to say, hey, demand is up. We got to process more crude oil into gasoline, and they're going to wind up buying more crude oil. That's the way this works. That's why market structure is so important, and it behooves us to know all about that, whether we trade commodities themselves in the futures markets or whether we invest in commodity-related companies.